Ladies and gentlemen, welcome back to the Permissionless podcast, of course, brought to you still, as always, by the team at Guardian. And of course, we're going deep with DeFi teams, building on the edge of what's possible with DeFi tech. And today we've got really a wonderful conversation with Lucas from IPOR, which is a protocol that has been around for some time at this point, offering fixed rate lending on top of protocols like Aave. And in this discussion, we get to go in depth on the kind of underlying technicalities and complexities of the IPOR protocol, but also discuss a little bit about how did Lucas even find his way in so early to a DeFi protocol that was really ahead of its time in terms of complexity and imagination. And then finally, we discuss a bit about what's in the near future for IPOR and what we think DeFi is headed towards in general. But of course, we will go deeper on that in just a second. My name is Owen, and over 3.5 years ago, I founded Guardian based on the premise initially that DeFi was going to house trillions of dollars of assets, and really we needed a stepwise higher level of security to be able to ship new code and complex protocols in that environment. And I'm happy to say that today we have achieved that standard with Guardian using not one, but two distinct auditing teams on the same scope, world-class security researchers, and a dedicated fuzzing engineer to fuzz mind-numbing edge cases into oblivion. In fact, we've been able to prove out this model to the point where we're confident in putting our own funds up as a bounty on the contracts that we review. And so at this point, we have achieved the standard necessary, and now it's just up for DeFi to catch up. And of course, without further ado, let's dive into this interview with Lucas from IPOR. Well, yeah, dude, I mean, first of all, appreciate you joining us and making the time to hop on and discuss with us a little bit about, IPOR, your journey into DeFi, what your experience is, and anything else in the Web3 space. But yeah, I mean, really, I think it'd be great to just start and get a sense of how did you first find your way into DeFi, and then we can discuss what got you into IPOR from there.
Well, thank you for having me. My name is Lucas, by the way, for those who don't know me, which is probably like 100% of people watching this. And well, the story goes back, several years. I was actually in Shanghai. I was living there at the time, and I met this guy who I now work with. And we had very long discussions about blockchains, and this is back in 2015, I guess. And at the time, I was on a skeptical side, like a old school gold bug, if you ask me. And but the idea of the blockchain was speaking to my heart, especially the self custody and a resilience of the blockchain. Is obviously it's not the same as gold, but it has its own unique properties. And he talked me into buying some Bitcoin at the time, and I bought some Bitcoin. I was even day trading quite successfully at the time, but I have no nerves. It's just too high stress for me. I'd rather build. That's what I was doing at the time, is on the engineering side of things. And but I got some Bitcoin. Then when I was moving out of China, about the same time, just maybe a couple months earlier, OKX or OKCoin, I think it was called this. It was called like that back then. They locked me out of my account with my Bitcoins because money laundering rules in China and all the foreigners. And even though it was fully legit account, and I had to prove the taxes that I've paid on the money that I put in my account, they said, you can't use it. And two years later, I almost lost hope that I will ever get it. I wrote it off, to be honest. But but anyway, I finally miraculously got it back. But the guy that I used to talk about crypto with, he called me out of the blue one day, and he says, listen, I have this idea, and we're going to build derivatives on blockchain. It's like, oh, tell me more about it. And he basically went into what DeFi is, how we know it, like, how you interact with Aave, how the flash loans work, and, how everything is variable rate. And, and he has this idea how to make variable rate fixed rate, through interest rate swaps. And, I'm kind of, I have a background also in economics. So, say, oh, interest rate swaps, you're saying. So, and we went into interest rate swaps and how they can work on blockchain. And he basically said, listen, I'm looking for a team. So I told him, like, listen, I know some people, they're excellent, they're absolutely amazing engineers, and you'll do fine with them. So I introduced them to him. But then they refused to go without me. And my buddy refused to take them on unless I joined. So they bullied me in joining, even though I was quite happy where I was at the time. It was, like a little corporate job, building apps for Fortune 100. And so I joined. I was like, I've been to a couple startups before. It's kind of fun. So that actually at that time I started getting myself into blockchain, like very, very deep into technicalities of it. But my journey is maybe different than most people in the blockchain because I came from as an engineer that was brought in to solve very specific problem.
Yeah.
Okay, so I was given the problem of building an interest rate derivatives and a constraints of the blockchain of Ethereum at the time.
Yeah.
Say how can we replicate this model on Ethereum? Given those constraints, like you cannot iterate over lists, and you need to keep portfolio of assets managed. And it was amazing challenge, and we did it, and we actually built a very sophisticated algorithmic derivative on Ethereum. It's still running, it's still being used.
Yep.
So can allow leverage to, I think theoretically to about 1,000. So it's pretty cool. Yeah. We run into some issues of like manipulation of the market, but I think we come around to find a solution to it. So it's this particular battle ain't over.
Very cool. So what year is this around where you're coming in and you're getting dragged into this very specific problem?
That would be 4 years ago. So this is 2001. Yeah, 2001. Yeah, 2001.
Yeah.
So I've been working in tech for about 10 years before that, various different tech projects.
Yeah, so coming in, this is right around the Bitcoin crash from like 60 to 30 or whatever.
Oh yeah, exactly. I've seen a couple of them already.
Yeah.
So yeah, I lost. I really don't. If I'm honest, I don't really pay attention to that much. I own crypto, but
you have to ignore it, or you're just too busy in this space. There's just so much going on 24/7.
Exactly. And you want to keep your sanity.
Yeah, of course. Yeah, at a certain point, you work with the tech so closely, and you see like just how powerful DeFi is with infinite composability, and anybody can interact with it, that it's like, the price really doesn't even matter. It's like this tech is, nothing else in the world has this like ability for an open financial system, and the compounding nature is only compounding. It's doing exactly what it needs to do with composability. But yeah, so that's super interesting that you specifically were dragged in for this very particular problem, and it actually ended up being like I think a cornerstone of IPOR and what you guys are offering. And I think it's the same contracts are used to this date, or probably some changes had to be made or some configurations or something like this. But so that's actually pretty unique. I actually came in around the same time, but obviously, did the whole like losing a ton of money on DeFi projects and then learning about DeFi and all of this stuff before ultimately we started doing security work. How did that individual know to work on interest swaps? Like what was their background? How did they see this opportunity in the marketplace?
Well, there is we look at Ava actually, when we were talking about it, we look at Ava, and Ava at the time had the fixed rate loans as a product. I think they discontinued it afterwards.
Yeah.
But it had a pretty quite a few people actually taking those loans at the fixed rate. And the rate was crazy high, and it just got us thinking that this actually, there is a demand for fixed rate, and everybody was trying to solve the fixed rate. And then Pendle at the time was addressing the fixed rate with their own unique model, and we thought like can we make this more efficient, because the problem with Pendle was, and this is before they rebranded, and that rebranding was actually a massive success.
Yeah.
and they improved the model also. You essentially were always limited by the amount of liquidity that the users would bring. And when we look at the traditional markets, majority of interest rate swaps are actually synthetic. So you don't really need underlying assets. And we're like, can you actually trade the swap? Can you trade the yield without underlying asset? Like pretty much you put some collateral and you trade interest rate of Ethereum. And we were looking at, actually, this is where the name comes from. The IPOR stands for inter-protocol offered rate or overblock rate. So, in traditional markets, you have this thing, well, you had it before it was killed, LIBOR, or various other indexes like SOFR or Poland, there would be a VBOR or whatever. And when you build your financial instruments, you normally do it off that rate. So that rate becomes your benchmark, and then you can trade your risk on that rate and get your fix or floating and switch between them using synthetics. And we thought, well, can we build something like this? And we designed it. We say, oh, we can build it. And we built the synthetic protocol. In the first couple of months, we actually traded over $4.5 billion worth of notional. So it was extremely scalable. But then we kind of run into some issues with like market manipulation. There's people that started, okay, can we manipulate the market in order to take advantage of IPOR? So we had to, it was like this, cat and mouse game where we had to build automation to, monitor the market and, cut essentially the depth of how many derivatives we could offer, depending on the market depth. So it was susceptible to be manipulated because the liquidity was thin. We had to lower the limits. And it was very unfortunate, but actually, I think we are now much closer to solving this problem than ever before with our new product working together with our old product. So that chapter, I'm happy to speak about the new product as well, but there was certain events that led us to working on a new one, and I think that both, going to work quite well together.
Well, first of all, there's a lot that we could talk about from here. So I think maybe before we jump into each like individual product area, and I definitely want to get more in depth on the AMM that you guys are using underlying here and how you kind of
So the AMM that we built for the derivatives, it's a bespoke a bespoke AMM that is for our derivatives specifically. So it essentially it has algorithms to calculate the risk. And it's actually a very unique solution because of those gas problems, we had to be very innovative. But then that led it to be a bit harder to use for traditional DeFi users because part of the risk parameters that we monitor and we use in the AMM, they're very they're extremely hard computationally. And we use quant models in the background, and those cannot be run on Ethereum. They're just way, way too heavy. And so what we end up doing in our AMM was to rely on off-chain calculations for the risk management to offer the swaps. So once the swap is open, it relies entirely on the on-chain data. Okay, but before it's open, the offered price for the offered spread for that particular swap is it takes advantage of the quant model that is running in the background, and then we essentially compile the set of data, we call it risk parameters. It's a whole array of parameters, and then we refresh it every couple seconds, or I think every up to a minute, I think. And then we have algorithm running on chain to fill the gap for that minute. And it's all signed by our Oracle. So the Oracle publishes the off-chain data with a signature, and then the contract will accept those data with the signature. We'll verify the signature, and then it will offer a swap if it all matches. So that was a very hacky way to solve the problem of computation. I mean, it works quite well, but the main problem is it's making it much harder for composability for the regular users. So this is product. This is definitely not a product that you can automate as a regular DeFi user. So this is you can totally automate it, but you need quite a bit of skill, and that kind of led us to Diffusion. This is the main current product that we have. But yeah, like the AMM was bespoke. We couldn't use any off-shelf solution because the product was so much different.
Yeah, and this was before even Uniswap v3. At the time, it was just Uniswap v2, I believe.
Yeah, I think when we started, there was Uniswap v2, and then in the meantime, Uniswap v3 came out. But we had attempts at solving the swaps with AMM from Dexys. I think there was a Volts. I don't know if you're familiar with Volts. They were using, I forget now, whether the V2 or V3 type, the Uni V2, V3 type AMM. But that was, they got exploited at some point because it's just not a good model for this. Pendle has its own bespoke, AMM. We're using slightly different, very different model because we literally don't rely on asset. We rely on the IPOR index that's compiled from the borrow rates on the Ethereum. So there is no IPOR index is a synthetic thing. Okay, we grab all the index rate, all the rates from Aves and DSR and so on, and compile that into an index, and that becomes a base for on which we trade. There is no there is no AMM that you can use unless you have that specific case.
Yeah, so the index is an aggregate of all these different lending venues of what the floating interest rate is. Well, it's not an exact average, but you
think about it like a LIBOR. It's a LIBOR of DeFi.
Yeah.
So we actually use it until this day. It's a synthetic, or it's a benchmark of like what the rates are in DeFi, and we use blue chip markets, and then we see how's the markets are doing, and now they're doing crap, but it's a cyclical market. They go up and down, and we can see it, and been collecting IPOR for like 4 years now. Or more than that.
Yeah. Well, talk about a product that has like lasting power. That's pretty impressive, especially in DeFi, to have something that's going on its fourth, fifth year at this point. So yeah, and we can definitely get into more of what you guys are building on top. But I just want to, for everybody listening, maybe we can walk through like what is the actual mechanics of an interest rate swap. So in my understanding, it's like you go and borrow USDC on like a Morpho or an Aave, and then you swap it for IPOR USDC, which is this index. And then, so you've swapped at a certain tick or bucket. Good to hear how you guys are delineating this. And then you hold it, and then that IPOR index trades wherever the interest rate goes. Yeah, interested to hear like how does that come to life? What's the mechanics?
If you don't mind, I would like to kind of step up the ladder of abstraction.
Yeah.
And maybe just start with what the interest rate swaps are. Okay.
Yeah.
So in the traditional markets, when you have you ever taken a loan, like maybe a mortgage? Mortgage is probably a good example. So if you take a mortgage, you can take either a variable or adjustable rate mortgage or a fixed rate mortgage, right? And if the interest rates are like normally the adjustable rate mortgage usually has a lower rate than the fixed rate.
Yeah.
Okay, because there is a risk the interest rate will go up, and then you're on the hook on the higher interest rate payments. So, but let's say the interest rates were low, and you were kind of reckless, and you say, okay, I'll take a loan at 1% adjustable, and then the rates go up, and then you wanna maybe switch to fixed rate because you expect the rates will keep on going up. So what do? You go to the bank, okay, and you have to refinance, meaning you need to get entirely new loan, okay, for another 20 years. But so this is what it takes to switch between adjustable and fixed. And normally you're gonna get a rate hike, okay? So maybe you got 1%, and now the situation changed, and you get maybe 6% fixed. I'm making those numbers up, but let's say 6%. Okay, imagine at the same time I took a loan at the same amount, but I took a fixed rate mortgage. Okay, I got it at 3%, and now I'm still at 3%. Okay, and you went from 1 to 6. theoretically, right? You went to maybe 1 to 5, but adjustable. So I have 3 and you have 5, and you want to switch to fixed. So what you can do is you go to the bank or refinance, or you can come to me and say, hey, Lucas, how about we do it this deal for 1 year? Because I'm guessing 1 year is enough and everything is going to change. For 1 year, we signed a contract that you will pay my floating rate, okay? And I'll pay you 5%, okay? So you paying me less than you would pay in the bank. So it's a win. I pay you, I pay you 3%, which is 2%, delta. I'm taking a risk if the interest rate is going to go up. Well, I get, so yours is 5, maybe we agree on 5.5. Okay, so I get 1.5%, 0.5% delta.
Yep.
And my cost of capital is also lower because I have my base at 3%. So you win, I win. Okay, I'm making money, you're making money. Bank doesn't make money, but for 1 year, I pay your interest, you pay my interest. You save, I get to earn some extra, and this is what actually banks do. If they want to switch, or in big corporations, when they want to switch from fixed to floating or from floating to fixed, they don't refinance. Okay, they keep their own loan or they keep their own deposit. Okay, the money doesn't move. All they do is they get a swap. And swap is essentially a contract for parties to pay each other's different rates. I pay you adjustable, you pay me fixed, or vice versa. So what we want to do with the interest rate swap is essentially replicate that model on chain. So we say the floating, the rate that's going to change, is the IPOR rate, and the fixed rate is whatever you get on the contract. So you can come to the AMM on IPOR and you say, I want to pay fixed, okay, of whatever the contract offers me, and I'm going to receive whatever IPOR rate is. And the AMM will calculate the cash flow difference between both rates, okay, over a period of time. So if you keep it for 30 days, you keep it for 60 days, you keep it for 90 days, you essentially get paid on the notional. So you say open $1 million notional, and you get paid interest on $1 million at the as a fixed rate, and then you pay floating also on the $1 million. So all you need to put in the contract as a collateral is part of the notional. Yep. So theoretically, the IPOR protocol allows for like 1,000 times leverage. So if you want to trade $1 million principal and then interest on that, you need like $1,000 collateral. But I think I haven't checked it, what the machine is saying these days. But it can lower that leverage depending on the market conditions. So if the market is extremely volatile, it will lower the available leverage. So interest rate swaps are extremely powerful. So they're second biggest class of derivatives in the world. Yeah. And I like to say this is the biggest class of derivatives almost nobody understands or knows about. Yeah. Because everybody knows Forex, right? Everybody knows options and futures and maybe even warrants, CDOs, SDRs or whatever. But interest rate swaps are, for the financial people pretty much only.
Yeah, and so and your approach is essentially kind of like a synthetic.
Yeah, so you can, what you can use it for, you can obviously directionally trade, say, oh, I think the interest rates will go up. Yep. So I go long interest rates, meaning I pay fixed and I receive floating. And if I think interest rates will go up, I go short. So I want to, receive fixed and pay floating, because floating, I presume, is going to go down. You can use it for that, but you can also use it to hedge your loans or deposits. Yep. So if you, you borrow on AVA, okay, at, right now the rates are like what, 5%, maybe. Yeah, maybe less, depending on the asset. Like USDC would have a slightly different profile than Ethereum or Ether. So say now the rates are 5%. I think they're going to go up. Okay, so my cost of borrow will go up with the floating. Yeah. So I want to hedge myself. So I have a position on IPOR where my swap is longing interest rates. So if the rates go up, I'll win on the swap. If the interest rates will go down, I lose on the swap, but I also win on my borrow position because I'm now paying less interest. And reverse would be true for the deposits. So this is what normally is done on in traditional markets. Yeah.
Yeah.
And to do it on like a large deposit, on large collateral, it would be insane. So that's why, I mean, it's a very efficient product. So you don't really need much collateral to secure that position.
Yeah, and obviously this index that you're using and how you're calculating the fixed rate is based on-chain values, is based on what the current rate is on all these venues. And so you talk about price manipulation. What did those kind of vectors look like? Did they just go to like an Aave and like literally manipulate the rate and then make guaranteed profit?
Yeah, so this is, if you allow to take, extremely high leverage, and you don't restrict how much money is funneled through, the derivatives, you can actually allow for extremely high number, like high notional,
Yeah.
even exceeding the amount that is in Aave or cross credit markets. So at some point it becomes profitable. Try to corner the market to exploit the derivatives, right? Because the derivatives are have high leverage. So what we end up doing is essentially we monitor the depth of the market and theoretical profitability of such manipulation, including things like, borrowing assets from another market and running some arbitrage or costs of capital in general to essentially keep the market issuing swaps until it would start being profitable to exploit, underlying even large credit markets to move the rate. So, I mean, this problem in traditional markets is not really that serious because markets are extremely deep.
Yeah.
And in crypto, we had times where markets were very deep just to observe that within 1 year, they would dry up so much that, it now is, you make a 5 million deposit into Aave and that moves the rate by 2%.
Yeah.
So even though, IPOR derivatives they're not susceptible to liquidation. Like if you use DEX AMM, that's another reason why you shouldn't use DEX AMM for anything like this. The DEX AMM prices the tokens, right? And there is the interest rate it has to be baked into the price of the token. And it may happen that with the, if the rate moves like from 5% to 40%, you get liquidated.
Yeah.
Okay. Because your token. Yeah. So, and the way it works with IPOR, we actually look at the time aspect. So the rate can move from 5 to 40%. That's not a problem. The problem is where the problem can be is like when it stays there for too long. So if you have a spike of the rate, to whatever number, and it's just a spike for a couple of minutes, I mean, you don't care. It's more of a 30-day interest rate payments overall rather than momentarily moves.
Yeah, and of course that's much more expensive to pull off than
Yeah, because you need to maintain that manipulation, and the market, but the participants come into the market, right, to take advantage of higher rates. So I mean, this is again playing into other thing that we just built. That in itself has a stabilizing, effect on the markets, and then the IPO rate becomes more of a trend, which is exactly what it was supposed to be from the start.
Yeah, and so I mean that's a good lead into this new fusion product that you guys are working on. What sort of problem did this come out of that maybe
That's a very good question.
Yeah.
So you see where we built AMM for the derivatives. When you have multiple positions open, you don't really care. Like you don't need to pay each other party, right, all the time. So all the liquidity that you have to make the market work, they're actually unused. So you keep them in your balance. So what we wanted to do from the start is to allocate them somewhere so they can generate some yield for the LPs. Even though they're not necessarily used all the time, they're just there to make the market. And so we built this kind of an asset management. But then we realized that if you want to change something, make different allocations, slightly different strategy for those assets to be making money, what we did at the time was a bit more too rigid. Okay, and it required a lot of work from us.
So very like
Sorry,
rigid.
I had the call. So it was a bit too rigid. So it required a lot of work from us to make any adjustments.
Yeah.
And we thought, well, like it's not a core of what we do, but we have to fix it because it just takes too much. Too much effort and too much time for something that should be fairly simple. So we run this because we in IPOR we run those sessions when we analyze different products. We do brainstorming, go deep dive on whatever product there might be out there. All the major ones we already did.
Yeah.
It was very hard for us to keep up with the changing market, make adjustments, run upgrades to contracts. And we thought like this is unsustainable. And, we have those brainstorming sessions we run every other week when we analyze products. And this time we decided like, okay, let's brainstorm what would solve the asset management problem that we have.
Yeah.
And at the time we have already analyzed, quite a few protocols like Yearn and a couple others. They're very similar. It's like, hey, can we get some inspiration from what these guys do? And but we wanted to be extremely flexible because flexibility at the time was not our strong part. It's like we're very good at squeezing, the efficiency, but it's very bespoke what we do, right? But let's make it less bespoke. See if we can make it very flexible, so we don't need to make all those decisions up front. How to make it so it's gonna be easy to work with down the line. So we designed this actually. So we brainstormed. It's almost like an internal hackathon. It was a design hackathon that we ran internally, and we came up with this concept. And we thought, well, this is pretty cool. So we think it can be built. So we scoped it. We built it as a prototype, and we tested it, and it was working quite nicely actually. So we decided to build it as both a standalone product, but mainly for our asset management. So then we ran our asset management through it, and it worked very nicely. And so all those assets the IPOR protocol was keeping, we could actually put them to work, and don't do it in a rigid fashion, but rather optimize allocation. Because we were doing allocation to blue chip credit markets like Aave and Morpho and so on. But this time we built in the Fusion. Fusion is built really with automation first approach. So it's really built for automation. And the way it works, you have the vault that you deposit assets to. So in our case, another protocol, which is IPOR protocol, was deploying assets here. And then the management of this vault is divided into different roles. So what we call an alpha is like a manager. Okay. So alpha, all it can do is to allocate assets according to the rules that are defined by the what we call an atomist. Atomist is essentially an admin of the vault. So the atomist says, you can put assets to Aave, you can put, and it will tell you what assets you can put to Aave, or you can maybe put liquidity into Morpho, or you can maybe borrow from Morpho these assets. Maybe you can swap on DEXs. Maybe you can harvest rewards from Fluid. So you design what can be done. You put the thresholds, you put the assets. You can, even put the fees, which was another issue that we wanted to solve. And then let Alpha to automate it. Okay. And Alpha is more like an off-chain service that has, permission to allocate, but that's it. It cannot withdraw the assets. It cannot arbitrarily put them here or there, swap it, or without any constraints on the slippage. So this way, we build this platform where it's extremely flexible. So you can we have right now vaults running strategies where they provide liquidity to credit markets, but when this is not profitable, they do rate arbitrage, And when this is not profitable, they do looping. Okay, so and one vault does all of those things.
Yeah.
And one vault has one automation, and it just constantly shifts the strategies and moves assets around. And as LP, you don't care. You just put assets in, and you kind of let it do its thing.
Yeah.
So it's actually it's been working extremely well. We've been outperforming some of the the household names on regular basis. I'm not going to talk about it. We'll have probably report.
Yeah.
I don't want to step on anybody's
Of course. Yeah.
toes, but whoever wants to do the research, they'll see. Yeah, so that was the problem that we were solving, the asset management problem, and it was so good that we say, okay, anybody can put money in it. So
Yeah, and is there like a vault token that comes with it as well, like a 4626 token or something like
yeah,
that?
it's a all 4626.
Yeah.
So, and from that perspective, you can even have structures where you have like a top level vault that allocates to those algorithmic vaults
Yeah.
underneath. So
Yeah.
we actually have, and this is going to be coming later this month in integration with one of the asset managers, where they use Fusion to allocate between their own vaults. So they have their own vaults. They're like a single purpose vaults. They're running on their own fixed strategies. And as the market conditions change, those vaults would become more or less profitable.
Hmm.
But they don't want to change the vault. The vault is already efficient. It's efficient doing its own thing. But they use IPOR Fusion to move assets between those vaults, the vaults that they own, they manage. So it's so it's pretty cool. It's pretty cool structure where we don't even compete with other asset managers.
Yeah. Yeah. No, an excellent way to like compose different strategies.
Yeah, yeah, you can do that.
Yeah, I guess that's like one use case that you're mentioning there. But as you've rolled IPOR Fusion out, like who is the ideal user, or like what other use cases have you seen for the product?
So the most users right now, and I'm not talking about LPs, because LPs are obviously, they searching for yield, and sometimes they don't necessarily care, how that yield is generated. But we see a lot of interest, crazy amount of interest from the asset managers. So we have asset managers that either manage their own assets, or they manage assets for their clients.
Mhm.
Or the third kind is they want to both manage their own assets, but they want to charge fees by managing other people's assets, like letting them participate in their own strategy. So I would say those are the three main kinds of users. I would call that clients really, because they come with their own
Yeah.
strategy, say, hey, we'd like to curate that strategy. Some of them, they want to automate it also, which
Yeah.
we help them to do through the SDK. Sometimes we help them to run the alpha. But you see, we can run the alpha, and they take the ownership of the vault. And
Yeah.
we can only do what they let us do. And everything is on chain, right? So you know where the assets are at every given point. You know what the logic of the vault is, what it can do, and it's very transparent. You see what fuses, we call fuses what fuses are connected, what assets are whitelisted, and in this way you can manage assets, and you can have sophisticated strategies, quite exotic actually. There's a couple that we're working on that they're really crazy. Like if you go to our front end, you will see there's not too many vaults right now, because there's quite a few more that are waiting for the prime time. They're already built, and they're just waiting to be launched.
Yeah.
There is one for Reservoir. You see, it's making about 20-some%. We actually running an upgrade to that strategy with the customer. I'm hoping to get on a call with them later today, because we need to, they need to change configuration to let Alpha, allocate assets in a new way to get some extra yield points. And so it's pretty, we stoked by how flexible this is, and how many different customers or how many different parties can actually take advantage of it. Like the use cases are, very diverse. It's not just, it's not just managing assets, but you can do looping, you can do liquidity provision on DEXs in ranges, or you're looping through the credit markets, you're looping through the DEX, LP tokens, rate arbitrage,
Yeah.
And those are the strategies that we're running. And often we mix them on the same vault. So one vault can do, looping, arbitrage, or DEX liquidity,
Yeah.
depending on what you want.
Yeah, I mean, you could even make like one of those like yield-bearing stable coins with this, like literally with one of the vault tokens, where one of the positions is you go and you borrow and you loop up on Aave, and then you go and you short on like a GMX or something like this.
Yeah, so if somebody is interested and wants to do that with IPOR, we open. Like
Yeah,
we see ourselves more as a platform rather than
yeah,
curator. So we're happy to work with anyone who has a idea for sustainable strategy. So happy to talk.
yeah. There's a lot you could do with this. So it sounds like under the hood, really the way it works is you have these fuses which you can plug in, and those are kind of the adapters between the specific integration.
Yeah, so from an architectural perspective, and this is probably interesting for you more than anything, is I've now lost the name. This is Diamond Proxy,
Yeah,
right?
Simon.
So we actually used Diamond Proxy on the previous product on it's like second version
Hmm.
to increase the flexibility of it, and we realized that it's a very very nice way to run the fuses
Yeah, it is.
because everything like the vault essentially becomes like your EOA.
Yeah.
Okay, so it retains ownership of everything, and you don't need to hard code functionality into the vault, but rather have fuses to delegate call
Hmm.
to other protocols. So like the fuse is stateless, has no, essentially the validation is performed on the vault with the params, with the logic from the fuse, and it has no balance, nothing. It's like a completely transparent way to give functionality to the vault,
Yeah.
and you can easily add it, you can remove it in the hard. So it's a very nice architecture that gives you tremendous flexibility,
Yeah, and I
and
guess
it's fairly straightforward.
with it being a diamond, like if a client wants to add their own custom fuse, their own custom facet to interact with, like let's say their own protocol or some really off the wall protocol that isn't already supported, then they could go and just write that themselves and
Oh, absolutely. So the catch is, on the front end, we would
yeah.
flag them as using unverified fuses.
Oh yeah.
And because we would like to, because we are a platform, but we would like to, make sure that there is a review of
Yeah.
what's used, so the LPs, they understand what what the risks are. So if you want to build your custom fuse and you want to use it and let others use it, because that's another thing, if you build fuse for yourself, every other vault can use the same fuse.
Yeah.
So, and there is no cross pollination, like the fact that I'm using this fuse, it doesn't affect any other vault using the same fuse.
Hmm.
Like everybody runs their own logic through that fuse, and nobody sees each other's moves.
Yeah.
And so that's actually a point. Like that's what we want. We want to see that there, where you expand functionality, like you build fuse for your own protocol, and
Yeah.
then all of a sudden every single vault can use that from like this, from the
Yeah, it's kind
same.
of like that's kind of the beauty of DeFi in general, as well as, once a primitive is built, then it can be used by the entire ecosystem on the chain that it's deployed on, and then also, I mean, now with interop, literally across DeFi as a whole. Like for
Yeah.
example, like with an Aave, like you guys are, building off of and adding on more functionality, more value proposition to Aave and Morpho and all of these. So yeah, I mean
Oh
that
yeah.
the compounding effect that we'll get more and more of as we get more and more people building cool stuff.
Yeah, I
Yeah,
mean, you
that
know
that
what? That interoperability of Aave, this is actually what convinced me to join, all this blockchain thing.
yeah,
Because and actually I was stoked by flash loans.
yeah.
When somebody explained me of how flash loans work, I was blown away. It's like this is the most amazing thing I've ever seen. So yeah, when you say Aave, it's I love Aave. Aave is beautiful. I mean, there's also morphos and
Yeah,
compounds,
yeah, of course we don't want to.
but
Yeah,
I like Aave. I like Aave. I think it's beautiful design.
Yeah, and I also wanted to touch on, so you mentioned a lot of the off-chain stuff that you guys have, like Alpha, to basically go and actually execute these strategies and carry stuff out. What kind of logic exists there? Is there any kind of like model or like
Uh,
that
oh yeah, it's. I mean, I don't want to spill maybe too much of the secret sauce,
okay.
but when you run those strategies, there's a lot of things that you have to consider, right? When you do credit allocation, you're mainly concerned about things like slippage, right?
Hmm.
Because let's say I have $5 million, and if I dump it in some small pool on Morpho, I'm gonna sway the interest rate so much that I was better off dumping it in Fluid
Yeah.
or Ava. So what Alpha does at this level is essentially looks at the slippage, and it simulates the market, because it can allocate to multiple markets at the same time. So it will seek the highest overall profit when it break down, will break down assets into multiple protocols,
Yeah.
to a point where, sometimes it may deploy less than, when you look at the numbers, you say, oh, it's one market is like 8%, the other market is 7%, and there is more allocated to 7 than to 8. And it's like, why wouldn't you delegate more to 8 rather than 7? And the simple answer is that's actually the more profitable approach, because you keep market above the kink with lower amount of money. So when you do the math, overall, you're making more. You're gonna have better rates nominally, but you will actually make less if you
Yeah.
if you drop the rate below the kink. So Alpha actually does this 4D chess, where it actually maximizes return.
Very cool.
But when you do things like looping, then it becomes much more complex, because
Mhm.
all of a sudden there is more to
Yeah.
watch. There is you need to worry about your LTV and growth of your both debt and the collateral. You anticipate things like, if you want to unwind, what's going to be the cost of unwinding, because maybe you need to swap. And if you swap, how deep is the liquidity?
Yeah.
Same thing if you want to ramp up the strategy. So for instance, if you take one of the vaults that we have right now, the reservoir vault that is allocating to SRR loop, we had a lot of, there was a tremendous interest in the beginning,
Yeah.
and people start putting money into that vault, and suddenly APR dropped. Okay. And the reason for that was that Alpha couldn't allocate any more assets.
Hmm.
If it would allocate maybe 30% of assets, and everything else was unallocated. And we were asked, like, oh, why don't you allocate more? I mean, you can maybe use lower leverage.
Hmm.
But no, because the interest rate model is such that if we allocate more at lower leverage, the vault would make less money. So the allocation had to be kept lower.
Yeah.
So what we did, we expanded the strategy to allocate remainder into liquidity on Morpho, which
Yeah.
would drop the rates and then allow us to look more at the higher leverage,
Okay.
and then increase rate from 12% to about 21. And now we extending that strategy even further, where it can loop into USDC USD,
Yeah.
and that will increase it by a little bit more. But it will pull the assets from the liquidity, which will drop the APR, then it will increase the APR through the other loop.
Yeah.
But as a consequence, the rates on the loop would be higher, which will have the consequences for other manual loopers on this pair.
Yeah.
But that's, I guess, their thing to worry about. So it's really, like, I'm so stoked every time I'm thinking about it. It's like this is such a nice thing.
That is
This is
really cool.
a finally product that I can use.
Yeah.
And I'm a risk averse person. Like, I'm more of a traditional mind.
Yeah.
Like I said, before we started the call, I told you I'm a more of a gold bug type person. So yeah, now we can and the liquidation protection, all of that, you don't all of a sudden don't need to
Yeah.
worry about.
Yeah, I mean, well, that's fascinating. I think one of the hardest problems is in DeFi, like you said, we have limited market depth, and it starts to become a really interesting problem when you start to try and scale a fund like this. Like, I'm not sure how much TVL you guys are working on allocating right now, but like I can imagine if you 10x, if you 20x that amount, you're gonna have whole different problems of like how do we allocate this?
Yeah, so that's the thing, right? So if you allocate $50 into credit markets, you don't really worry about slippage, right?
Yeah. Yeah.
But the alpha that we built for at least for the credit optimizers, and I mean for all the vaults that we automate personally, because there's other vaults that will come into production that are managed by other
Yeah.
parties, and but those that we built at least, we can probably scale them to a very large amounts.
Hmm.
And we can manage them from small to large because of the simulations, the way we run simulations. And this is not a beautiful thing because you don't need to change the strategy.
Yeah.
You just adopt the avenues where you
Yeah.
can allocate assets as you scale because you can allocate assets, just the rates will drop.
Yeah.
So what you do is you think about, okay, maybe I change the strategy, you do this other thing as well, and then your strategy evolves and evolves and evolves with the market, with the size, and you don't ever have to tell your LPs to move their assets. They all stay in the vault, and your vault can be evergreen.
Yeah, and this is where it seems like you guys had incredible foresight on making it as flexible as possible because there's going to be liquidity pools and, areas where you need to be able to get access to. And with just being able to spin up like a new fuse, you can pretty easily.
Yeah, that's exactly right.
Yeah.
That's exactly right. And yeah, so we're pretty happy about how it turned out. And even though markets are crap and everybody's thinking about it, I don't know when this is going to air, but for the record, today markets are crapping themselves.
Yeah.
Maybe a bit better than yesterday, but there is a demand for safety, I would say, and low maintenance allocation that is efficient and transparent.
Yes. Yeah, of course. And another thing that, of course, if you guys you have this standardized infrastructure and you get this distribution effect where if you expend all the resources to, first of all, make the smart contracts and manage the alpha off-chain aspect and all of this stuff. But then you've also got this trusted vault that can be distributed to tons of clients and stuff like this, where it's been security reviewed. It's got all like you can secure this one piece of code and then distribute that to many different clients. It could be different kind of clients, and they can also inherit the same sort of security principles that you guys have already invested everything into. And so I think
Yeah.
that scales very nicely, and it gives like you said, like people are, at the end of the day, they're worried about safety and they want to have efficient allocation.
Yeah, and when we talk about safety, there is a lot of stuff built into the vaults that are, for the safety reasons. For instance, every user that interacts with the vault can receive a time lock. So you can define a time lock on the user that can change settings of the vault.
Yeah.
So, I can add fuses, but we can say, this particular vault requires a week before the change of fuses will go into effect. So everybody can review, whether they're happy or not and move their assets if they feel that's the right way. So that's one thing. You can actually delegate your management to DAO tools like Aragon. So from the get-go, the vaults are compatible with the Open Zeppelin votes.
Yep.
So if you want that, you can have your vault track your balance over time, and then that can be used by Aragon to manage your voting power. And then because we use Open Zeppelin Access Manager, that also integrates right into Aragon. So there's a lot of things like that we were trying to put into the core vault from the get-go. And there is, I mean, I can nerd out about details, but I'll probably bore people to death.
No, I mean,
if somebody's interested, I'm happy to continue that conversation.
no, of course. I mean, with all of this, like it seems like once we get this infrastructure up, there's so many different things that you can plug into it and adapt it to use. What are the main things that you guys are working on right now? What's biggest on the pipeline for you guys at this moment?
Yeah, so the biggest thing right now for us is how we can standardize our alpha approach, because we have so much demand to run alpha that
Yeah.
if we only could, we would have about 40 pools open right now or vaults. It's just some of those strategies are fairly complex. So we now thinking how we can change our code base really to make it easier and faster to assemble those strategies on alpha side. Because I think right now it's fairly bespoke. I mean, it's extremely detailed, but it's almost a custom approach for every single vault. And we're thinking, how to improve that so we can bring more vaults online faster. I mean, as far as the vault goes, we consider it feature complete, at least for now. So we mainly focus on alpha.
Yeah, I mean, it makes sense. I think, I mean, it sounds like that's your real secret sauce, is that like off-chain management.
Well, we'd like to have actually more parties to bring their alpha skills up to the platform. If anybody's listening to this and they want to run automation, they know how to write Python or Java or whatever they want, TypeScript, and they want to run automations for, managers with millions of dollars, I mean, hit me up. We'll hook you up, and we're very happy to, for others to step in. I mean, we enough demand not to worry about, being bored.
Yeah.
So
yeah, and I mean, if in that sense, you guys become the platform, and you're connecting the off-chain models and the managers with the folks who want to allocate capital. So yeah, I mean, there's a lot of opportunity there. But is there anything else that you want to sort of shout out? What are you guys working on? Any kind of like offers that we can draw people towards? Like obviously depositing.
No, I mean, yeah, of course, if you, everybody welcome to visit app.ipor.io to see. I mean, it will take you straight to the IPOR vaults, the fusion vaults. If you can also participate in the liquidity provisioning for the derivatives. So then you get yield from the derivatives and also from the vaults. So it's like a double benefit if you want. And yeah, we will have more and more vaults coming in April this year and beyond that. So just keep your eye and see what sort of strategies come up and they are available.
Excellent. So that's awesome to hear, man. Well, I'm looking forward to more of the vaults coming online and seeing what kind of fuses you guys get up and running, and all the asset managers that come on. It sounds like you guys are talking with a few potentially big ones, so excited to see what comes out of that. And of course, we'll have Twitter and website down below, so if anybody wants to go and check out IPOR and check out some of their products that we talked about and just generally see what they're up to, you can go and see that in the description below. And yeah, dude, appreciate you hopping on and taking the time to discuss with us. It was awesome to hear about what you guys are working on.
Oh, thank you for having me, and thank you for this wonderful conversation.
Absolutely.
Thanks, Lucas.
Okay, my pleasure.